Our next speaker is one of our keynotes for this conference, inshallah. So our next speaker is Blake Goud, the CEO of the RFI Foundation. Blake has more than 15 years experience researching Islamic finance and working in a compliance and investment officer role in the finance industry. His published research has covered a variety of topics in Islamic finance relating to ESG, social finance, climate-related risks, fintech, and public finance. So without further ado, Blake Goud.
Assalamu alaikum. Good morning. Thank you to the organizers from Guidance College for inviting me to speak with you at the second North American Conference on Islamic Finance at the University of Houston. Financial inclusion is often used as one of the examples of the social issues in ESG, environmental, social, and governance, especially when you're talking about the financial sector. When I mention ESG here, it's talking about how ESG issues have a financial impact on companies. I'll return to this point. The context of the concern about financial inclusion that I'm speaking about today is that historically the financial sector has not done a good job at being inclusive. In some cases, it's explicitly excluded people, specific types of customers, and Islamic finance developed in the US in response to a few different forms of financial inclusion, and some of them are unique compared to what's usually associated with financial exclusion. Usually, financial inclusion focuses on removing the barriers created by the financial sector, by banks, that make products exclusionary for significant groups of people. In the case of the financial exclusion experienced by Muslims, consumers' preferences that exclude many of the available products plays a substantial role in ways that are not simple to address for most of the financial institutions. It would be a misnomer to call this voluntary financial inclusion. It's not that financial products are not available or not accessible for many Muslim consumers. The available conventional products are in substantial contradiction to Muslims' values. Many Muslims will therefore refuse to use products that are otherwise available to them for reasons that don't have to do with the cost of the finance or the terms. For most of the history going back to the 1980s for Islamic finance in the US and elsewhere in North America, the motivating factor has been addressing some of the key product gaps for Muslims in financing their biggest household priorities. That is housing and retirement. If a conventional mortgage is not an option, it makes it harder to buy a home. If you can't invest your savings in most of the investment products available, it makes it harder to save for retirement and many other goals, from buying a home to accessing higher education, even to getting a vehicle. I mentioned ESG earlier as a motivation that's driving action on financial inclusion in conventional finance, and why those institutions may consider Islamic finance to be an important piece of the solution. I'll return to some of the areas where there's other opportunities around the broad compatibility between Islamic finance and ESG, where there hasn't been a lot of overlap until recent years. In North America, Islamic finance has been primarily focused on expanding the footprint across product segments where the opportunity was overwhelming and where the cost related to financial exclusion hit consumers the hardest. There's some unique conditions in the US, especially in the way that finance is regulated, that creates some of the significant gaps that exist in the market and makes Islamic finance in North America different than the way that it operates in other countries. As I delve into some of the ways that technology can address some of these gaps, it's helpful to remember that technology is just a tool and it's impacted by the environment in which it's adopted. Let's dive into the details about the landscape of financial inclusion. The World Bank's definition is focused on whether consumers, meaning individuals and businesses, quote, have access to useful and affordable financial products and services that meet their needs for transactions, payments, savings, credit, and insurance delivered in responsible and sustainable ways. The US scores very highly on rankings for financial inclusion, although Muslim Americans have often not experienced that level of financial inclusion. When I was looking up some of the rankings of financial inclusion around the world, I found an article about the Global Financial Inclusion Index produced by the Principal, which was mostly concerned with the fact that, according to their ranking, the United States had dropped from second place globally to fourth place. Below these top-line metrics, showing that the US has high financial inclusion, there's a lot of gaps in the financial inclusion that exists in the US. And you can see that as simply as looking at the growth of payday lenders in many communities. A lack of financial inclusion has presented an opportunity for predatory lenders to step in, and they have taken the opportunity. Financial inclusion in the US is highly unequal, and Muslims are excluded in ways that are both similar and dissimilar to the wider experience of other Americans. Within the more mature segments of Islamic finance, we see a lot of focus on providing credit, or more specifically, financing products. Within savings, particularly those related to investments, have developed the most. Insurance has been a challenging area to see develop within North America. And payments generally doesn't need much effort. The payments are already possible if you have a checking account that doesn't pay interest and other conventional platforms. If you're looking from the perspective of equity investors with Sharia screening, companies like Visa and MasterCard that power most of the payments in the US are Sharia compliant, meaning that most of their earnings are from Sharia compliant sources, as long as they're not generating substantial revenue from lending money, which differentiates those two from companies like American Express or Square that have more lending activity. The payment side is taken care of. The financing products for Muslims in the US is dominated by home finance. These products have contributed to an increase in financial inclusion, but that has been incomplete. Looking back at a survey that was done by Pew in 2018, Muslims reported having homeownership rates that were 20 percentage points lower than other Americans. For as much ink has been spilled about the structure of the products in the market, a 20 percentage point gap in home ownership between Muslims and other Americans isn't as simple as just the products. It has many causes. The hundreds of thousands of Muslim households that you'd expect to be able to own their home, but don't, are not excluded purely on the basis that they refuse to use the products available or a conventional mortgage. There are other things going on. Some of these, the lack of suitable diversity of products that we hear about a lot has been a part of that, but financial inclusion is a multifaceted challenge. The Muslim population in the US is impacted both by traditional forms of financial exclusion and some unique forms that they're often referred to as voluntary financial inclusion, even if they don't seem so voluntary to those who are impacted. Stepping back for a minute, traditional efforts to support financial inclusion often focus on reversing the causes that lead people to be excluded from access to financial products, such as due to income or other characteristics that create a barrier. For example, people living in rural areas may not have convenient access to bank branches and are often cut off or marginalized within the financial system. People with low income may be viewed as marginal customers from the perspective of a financial institution. They have a high cost to service and limited revenue potential from the financial institution's perspective. Discrimination also plays a role in financial exclusion. And sometimes illegal actions are hidden under the cover of economic or geographical sources of financial exclusion. Many of the regulations for the financial sector and banks in particular that are in place today were developed to offset unfair practices used by some financial institutions. Different Muslim American communities may experience different or overlapping forms of financial exclusion. So we're talking about income, geographical, ethical restrictions. For example, Muslims who own or who earn over $100,000 a year account for about 1/4 of all Muslims in the US. And that's the same percentage of the population as a whole who earns more than 100,000. In general, this community would be an appealing customer base for financial institutions, but many will choose to abstain from non-Sharia compliant financial products. This is one of the forms of financial exclusion, and it's the one that most Sharia compliant financial products have worked to address by providing Sharia compliant alternatives to traditional products to consumers who would otherwise be highly sought after by the financial sector. Some of the gap in home ownership is likely due to the lack of access, for many reasons, to products that cure the Sharia non-compliance of traditional mortgages, because the Sharia compliant versions are not readily available in all parts of the country. Another big share of the Muslim population in the US faces a different situation. 40% of Muslims live in households with incomes under $30,000 a year, which is significantly higher as a proportion than the national average, where 32% of Americans live in households with income under $30,000. For a family of 4, that's just underneath the federal poverty line, and is well below the federal poverty line for larger families. The median Muslim in America lives in a household earning less than $50,000 a year. People in the lower half of the income spectrum, and the nationwide median household income is about $67,000, face additional sources of financial exclusion. For Muslims among the bottom half of the population by income, face all the same constraints as other Americans with lower incomes, and many will also avoid finance entirely to avoid conventional interest-based financial products, or they'll not seek out financial advice because of the conflict between what's available and what their values say they should seek out. It's important to remember that these Muslims are also in need of financial services, but you have to overcome the barriers that they face beyond just adding Sharia compliant to the requirements of a product for it to be considered useful and affordable, which goes back to the definition of financial inclusion. Let's take a look at some of the characteristics of the market as a whole for Islamic finance and how it's either supported or inhibited the development of Sharia compliant products. Home finance and investment products have thrived, and I think at this point their presence can be taken for granted. These services address some of the largest financing and investment needs that households have. Their large transaction sizes and account values make it possible to offer price competitive products more easily. Designing a product that might have natural appeal among a small segment of the American population, Muslims in the US account for about 1.1%, still produces a large market opportunity within home finance and within investments. These markets are measured in the trillions of dollars. There's also a large involvement by the federal government in both markets that help companies that provide Sharia compliant solutions to reach efficient scale, despite serving a small and geographically very spread out and diverse population. That's not a small achievement. The financial sector, and particularly the banking sector, is not a national market in the US the way it is in many other countries. For retirement savings, regulations are nationalized to a degree by the Securities and Exchange Commission and the Department of Labor for retirement plans, instead of at the individual level for most providers and in most of the activities that they engage in. For mortgages, the federal involvement that's most impactful is on the financing side. The National Association of Realtors says that 70% of all mortgages are bought by either Freddie Mac or Fannie Mae. And so the criteria that these government sponsors enterprises, GSEs, set to evaluate which mortgages they'll buy has a strong influence on the market as a whole and the way that real estate finance operates, because these GSEs are such an important conduit for liquidity in the market. So the next slide is, what do we mean when we talk about a large market? I said the total US market for these products is in the trillions. Last year, there were almost 8 million mortgages originated in the United States. The average size of them is around 330,000, which means new mortgage originations for home purchases and refinances last year was $2.5 trillion in America. If home ownership was accessible to Muslims as it is to other Americans, we would expect to see $30 billion of new mortgages originated each year from Muslims. And that doesn't include things like home equity line of credit that can come and is often provided by the same providers. There were 2 to 3 million of those lines of credit open last year. On the retirement side of the equation, retirement plans like 401ks and IRAs hold nearly $40 trillion of assets. 11.5 trillion of those assets are in individual retirement accounts, IRAs, which have a broader choice of investment options for savers. If Muslims' share of total wealth in retirement savings vehicles equaled their share of the population, they would control $416 billion of retirement assets, and $127 billion of that would be in IRAs, where Sharia-compliant investments are often more accessible. Muslims are a big market in the US. The existing providers of the two dominant areas of financial services that are out there still haven't reached much of the market, even though they're offering products that are relatively easier to deliver. There are a few other areas that I think are much more untapped. Vehicle finance, I mentioned earlier. Islamic banks around the world provide this type of financing, but it's not widely available in the US. Small business financing. Businesses have a lot of different needs in terms of things they could use with access to finance. And limited access to finance can put Muslim business owners either working with conventional banks or letting their business be hampered by constraints around working capital. Personal finance, there are many forms of personal finance, secured forms like the home equity line of credit and other unsecured forms. But one of the major considerations for expanding this particular area of finance is that consumers, there has to be an awareness among the providers, is that consumers may be equally harmed if they become over-indebted using Sharia-compliant structures, just the way they are when they become over-indebted using interest-based loans. And I think one special case of this is student loans. College graduates face a lot of challenges with the debt that's often necessary to pursue higher education. With the higher education market the way it is, there's undoubtedly a trade-off for every student and their family to make between pursuing the education that will help them in their career advancement and the opportunity costs that come associated with debt and the consequences that has, which can last a long time. If you look at other markets that have tackled similar issues, the design of the Sharia-compliant student loan product in the UK, which hasn't launched yet, but would likely serve as a model for anything developing within the US, doesn't really fit with the higher education market that the US has. The UK's product requires an environment where financing of education has payments that don't start if you don't until you earn a certain amount. They have payments that are based on what you earn, not the financing you need. The hurdles, which have been significant in the UK, would be even higher in the US, but it is an area of significant need that hasn't been addressed. For many of these types of financing that I've just described, a natural partner, a natural provider for many communities would be a community bank or credit union. However, there's not been much adoption of Islamic finance by community banks and credit unions. There have been a few, and even when they do, Islamic finance products that are offered through these institutions, and I came across one recently in the Pacific Northwest called Craft 3, which is a community development financial institution. It's very narrowly targeted towards commercial real estate for small businesses. So there's not a wide diversity matching the needs, the financial needs of small businesses. And the same goes on the personal side, on the personal financing needs. The reason for this is that as important as these financial needs are for consumers, those consumers are not concentrated within a single market in a single place that gives enough scale to be compelling for most community banks or credit unions. If they were that concentrated and where they are in this country, you do see community banks serving the Muslim market with Sharia compliant products. Where they're absent, if there was sufficient demand at a concentrated level, local level, you'd see a newly established bank or credit union stepping in. And I was glad to hear earlier that there's kind of plans in the works on a credit union. There's two ways to address this problem. One is to work making Sharia compliant products appeal to a wider market than only Muslims. This often appears to be the easiest approach if you start looking at the market optimistically with the idea that Islamic finance embodies values that can be appreciated universally by Muslims and non-Muslims. It has the appeal of sounding good and having a core truth behind it. But in practice, that's often not how market traction's gained or sustained. The idea of shared values helps start a conversation, but the product gains traction by serving a customer's need better than the other products that exist. And even if you haven't seen that happening much in practice, that traction growing and the product being superior on its merits, attracting more customers, it's not impossible for Islamic finance to do in the US. It's hard, and it's going to need momentum starting within the Muslim market to get the ball rolling. Success within the Muslim market is probably a necessary but not sufficient condition for the success of Islamic finance in the wider market. An alternative approach, or perhaps just an approach that can at least make it easier to radically increase the market share of Islamic finance in the US, is to lower the minimum efficient scale to provide Islamic finance using technology. One of the biggest challenges in delivering financial services is that there are fixed operating costs that substantially affect financial viability for institutions until they reach a certain size. Operating a financial institution that serves a small niche within a particular jurisdiction and the way that the US regulates is often state-based, so small market within a single state, produces a relatively high bar to cross the economic opportunity of the Muslim market in a particular location to cross that threshold and be viable. The combination of small local market size, barriers to financial inclusion, and the fixed cost of institutions operating to serve it in the traditional way can really inhibit the growth of Islamic finance in the US, and it's been a big part of the slow growth of Islamic finance in the US compared to other places. And even without the Sharia compliant requirement for products, community banks also are struggling in recent years, although they have shown that they have a unique way to punch above their weight in some areas I was reading about how community banks in particular were much more effective at reaching out with the government support through the pandemic loans because of their stronger links with their customers and the communities that they operate within. They were much more effective than the large national banks at getting money to people who needed them to keep businesses afloat during the pandemic. Providing Islamic banking products through these community banks is difficult, even though there's no regulatory barrier to using products like Murabaha and Ijara that Islamic banks around the world use. Those are not the barrier. The source of the problem is also the source of the solution. Community banks and credit unions could be the best institutions able to understand the needs of their local Muslim community. The business case for a standalone institution might not be strong in most communities. I'm glad to hear that it's strong enough to get momentum for a credit union in one more community. And there are limitations to how community banks and credit unions, how wide they can offer their services, just the nature of how they're regulated in the US. Community banks can be part of the solution by partnering with fintechs through banking as a service, either bank by bank, a fintech working directly with banks, or through platforms that provide that meeting point that operate in the business of connecting banks on the one hand and fintechs on the other. The fragmented regulatory environment that you see at the state level won't change. Each community bank that has a fintech partner that it engages with will still have a unique set of regulatory requirements based on their own local regulation. That's often done at the state level. They will have to be comfortable with the way that they divide responsibilities, particularly around compliance between the bank and the fintech. And that's been an area where there's been increased regulatory scrutiny because of some notable failures that have impacted customers' ability to access money that's held with a bank transacted through a chain of providers that are fintechs. It's going to be, that's one way. The other way, but it would be through a national bank. But for those banks, and I've talked to some of the banks, and it's hard for them to get their head around how it would be, how they would be able to justify on commercial grounds establishing an Islamic banking window that would be accessible across the country. It's hard to set up additional community banks that are specifically focusing on the Muslim community. So, because not all financial products that Muslims need have some federal through line that helps pave the way for providing services across state lines. Technology provides the only good tool right now to make financial inclusion possible, to expand access across a wide range of services in all the places that Muslims live across the United States. There are over 4,000 community banks in the US. Many are facing commercial pressures to work with fintechs, who are sources of new revenue through providing innovative products. And there are millions of Muslims who want to have a choice of an Islamic finance product to consider, or who are foregoing opportunities because Islamic finance doesn't currently address their needs. One of the challenges for these types of fintechs is they have to explain to their investors why they have a better path for growth if they're just focused on a relatively small group of consumers in the United States. There's a few ways to rebut that concern. They may have a path to grow that's relatively uncontested. As the case, there's a lot of financial products, or they can serve a part of the market where there's many Muslim consumers who currently use conventional financial products and wish they didn't have to, or who don't use financial products at all and wish they could. Islamic fintechs can also initially target the Muslim market, but that's not their full market. Nothing prevents non-Muslims from using their product or from those companies pursuing non-Muslim customers. The more successful a product is at serving the diverse needs of the American Muslim community, the more porous the border around that market, that target market becomes, and the greater the prospects of reaching a far bigger market. If this requires working through a number of different community banks, then fintechs that are addressing the Muslim market in many places will build up infrastructure using banking as a service that allows them to deliver a range of products across a wide range of communities, which provides them something defensible, something that other companies, other competitors would have a hard time replicating. The next question that I hope everyone's asking is why now? Why hasn't this happened already? One of the big changes that's underway in the financial sector is the development of open banking regulations that are expected to be released in the next couple of weeks by the Consumer Financial Protection Bureau. These are designed in part in response to some of the challenges that have emerged from fintechs and banks working together, particularly around the handling and exchange of consumer data. And so these regulations will help clarify for banks and fintechs who are involved with banking as a service or curious about it, as they seek to develop new products, how they might be able to tap that market. And it's expected to grow the market for fintechs. We know that fintech startups have been really good at uncovering opportunities that exist in plain sight. The Muslim market has been known to be large in the United States for a long time, and yet we've seen relatively little change over the years. And we also see that if just making Islamic home finance products available hasn't closed the gap in home ownership among Muslims, even if the population you expect to be able to take advantage of it the most is represented among the Muslim community at the same rates as the population as a whole, then maybe it can't just be solved with one product. And this gets back to the discussion of financial inclusion as an ESG issue for the financial sector. The reason that financial institutions see it as more than a risk, more than just a source of risk from regulators if they're not making their products available or if they're engaged in exclusionary practices, is because financially excluded consumers do make a large unserved market. And it carries a negative impact for those people that are excluded as well. So for those who are familiar with the way that ESG approaches things, either as a financial materiality or impact materiality, financial inclusion touches on both. It has a financial impact for financial institutions that are missing customers, and it has a negative impact on the economic outcomes for their potential consumers. And within the Muslim market, you have to realize that it's not just the product. It's not just a home finance product that allows somebody to buy a house. You don't wake up one day and say, I think I'm going to buy my first house today. And then the next day you own the house. You have a whole series of interactions with financial services that gets you to the point of buying your first house. It involves establishing and strengthening your credit history, which is hard if you avoid conventional non-mortgage finance, and Sharia compliant versions of those products are not available. There's financial barriers to accessing higher education if you avoid interest-based financing. That impacts your access to home finance. It impacts how attractive you are as a customer to the providers of home finance. If you face barriers in financial exclusion that makes it harder or makes it impossible to start and grow a business, or if you don't have access to financial literacy specifically around the ways that the financial system works in the US, all of that creates additional barriers that can't be solved with just a product. And we're not in a steady state right now. The ESG issues besides financial inclusion, like climate change, are also going to have an impact on the degree of financial inclusion or exclusion of communities that are most affected by financial exclusion. It raises the barrier for people to access finance. And when financial institutions approach it, although I mentioned financial materiality and impact materiality as being important, most financial institutions, most investors, most companies focus on ESG from the perspective of what's the risk, what's the opportunity, what's the monetary, what's in it for me. And as we're starting to think about the impacts of climate change, you're not going to get into a situation where there's just a clear path that everyone agrees on, that everyone benefits from at every step along the way. But the way that ESG has approached things is really driven by that financial perspective, contrary to what it's often alleged by its critics. Instead of substituting ethics and values, ESG just prices it in terms of dollars and cents. Okay. And so there's always going to be a value judgment. And getting here to close in terms of thinking, kind of opening our thinking about what Islamic finance can do. There's always a value judgment as we're approaching issues like climate change, regardless of the metrics that are developed to support that decision making. And within Islamic finance, what we see is that there's a well-developed process of Sharia governance that offers a framework for how you balance financial and ethical implications of economic decisions. As these decisions become more stark on environmental, social, and economic issues, there's increased demand for clarity about the trade-offs that are being made by financial sector stakeholders. If Islamic finance continues to work and grow and reach more and more of the Muslim population in the US and shows itself to be a strong area of growth, and it can demonstrate that Sharia governance process in action, that might be one of the paths where Islamic finance comes and appeals to a much wider audience by showing how you embed ethical choices within financial and economic decision making. And I hope I've outlined in here a path where technology can fill some of the gaps that exist today and to give Islamic finance more relevance in the market. Thank you.